Test, test.
How much information that project that my answer is you should share as much as you have.
Hello, everyone, and welcome to Wilkin and Guttenplan's continuing series of webinars. Today, we're going to be talking about capital projects and understanding the pieces. We have three panelists with us today, Mitch Frumkin, Ron Perl, and Mohammed Salyani. So, we'll go through a little housekeeping rules first. First of all, the webinar will last approximately 1 hour. We'll do our best to stop exactly at 1 o'clock. To ask questions, please use the questions pane in the GoToWebinar dashboard on your screen. At the end of the presentation, we'll answer as many questions as possible. The webinar is being recorded and will be uploaded to our website, www.wgcpas.com, and additionally, a PDF version of the webinar will be emailed to all attendees. We'll also be sending you a survey after the webinar via email. Please return it because we do value your comments. We will also have a few polling questions throughout the webinar. If you can answer them using the instructions on your pane, that would be great. We'd just like to get a little bit of feedback from you during the webinar. So our first speaker is Mitch Frumkin. Mitch is president of Kipcon, Inc., an engineering consulting firm that specializes in working with community associations for more than 25 years. His firm prepares specifications for many different types of capital improvement projects. During the planning stage of these projects, his firm is involved with reviewing reserve studies in regards to project phasing and component selection, not only to make sure the money is available to perform the work, but also to look at life cycle cost savings that are available with energy-efficient equipment and components with low maintenance. They also work with their clients to bid and oversee the projects that they design as the association eyes and ears during construction. Okay, Mitch, welcome, and it's all yours.
Thank you very much. What I'm going to be talking about this morning is, for these type of projects, is the planning and specifications, bidding, as well as contract administration. And the first question that you ask is, why are you even doing the project? And I just want to give you a short example. There's an association where I got a phone call just a few weeks ago that the reserve study said that they should be replacing the driveways throughout their community, so they wanted a proposal to do a specifications for the replacement of the driveways. After talking to the manager and explaining to her that the reserve study is a budgetary tool, and it means that not all the driveways have to be replaced at once, but some may be replaced in 2 or 3 years, and only a few of them may need to be replaced in the first year. What we did is we came up with a plan of attack to replace the driveways over a 2 or 3 year period. So the point I'm making is that you really need to be very careful about why you're doing the project and not solely base it on the reserve study because, again, that's meant to be a budgetary tool. Some of the reasons why projects are done are ongoing problems. For example, on some of these driveways, there were trip hazards or the pavement was breaking up, so there are ongoing problems. The other is proactive versus reactive. You want to be proactive because replacements can make a big aesthetic difference in your community, such as a roof or siding, and which maintains the property values you can actually add to them. Or there may be other reasons in your association that you decide that you want to do a capital improvement project. When you're doing this, just making these decision-making, going through the decision-making process, you also want to get involved with the planning, which is very important. Now, this graph that you see up on the screen gives an example of an association that has 4 boilers. According to the reserve study, all four boilers should be replaced in 1 year. And again, going back to what I was talking about before, what the association did was they looked at their schedule and said, if we do replace all the 4 boilers this year, we have $600,000 in our account, and it's going to cost $700,000 to replace them all, and which would leave us with a $100,000 deficit, which would require special assessment or borrowing, which is something I'll be talking about later on in today's webinar. So what we did with them is we took a look at it and said, okay, if we phase those boilers over 4 years and do 1 a year rather than doing them all at once, that they won't run into a deficit, and actually they'll have a surplus in their fund of $200,000, as you can see from the graph. So it's very important that when you look at a project and doing it, whether it's boilers, paving, roofing, if you have a number of buildings, that you look at doing it over a phased period of time rather than all at once, because it could help you with your funding. And again, it may not actually all need to be done at once because the reserve study says that. Now I want to touch on life cycle costing. When many associations do replacements, they're replacing what's there with something that's very similar to what's there without taking a look at any opportunities for life cycle costing. For example, if you have the boiler I talked about a minute ago, and it has a $175,000 replacement cost with a 20-year life, that means you're paying $8,750 a year for the replacement of the boiler. But the other thing you need to take a look at is the energy cost, because they're directly tied to each other. And in this case, it's $100,000 a year in energy cost, which means your total cost for that boiler is actually $108,750, which is both the replacement cost as well as the energy cost. If you take a look at now using a high efficiency boiler, what happens is many people look at that and say the high efficiency boiler is going to cost more money, and in this case the high efficiency boiler is now $220,000, has the same useful life of 20 years, which relates to $11,000 a year instead of the $8,750 a year. But what happens is your annual energy cost will now go down by $25,000. So your total annual cost, instead of being $108,750, is $86,000, resulting in a savings of $22,750, not including any incentives that may be available. And I will mention, in the state of New Jersey, there are many, many incentives available for replacing anything that uses energy. But this is an example of life cycle costing and why you should not just look at replacement costs, but you should also look at the cost of energy, or in some cases actually the cost of maintenance. Now you've made the decision what you're going to replace and when you're going to replace it, and we start getting involved in the description and preparation of the specifications to go out to bid to have the work done. The specifications is overall a description of the project, and it could be made up with many different parts. For example, the drawings that most people are familiar with is a graphical picture of what the final product should look like. So the drawings are a graphical representation. Then, for the larger projects, you may get involved with specifications, which is a written specification, sometimes like a book, which describes the materials that can be used and gives some owners, and it specifies the exact type of equipment, may talk about what type of manufacturer you use and that type of thing. So in the larger jobs, sometimes you get involved with written specifications, but on many jobs, those specifications are actually included on the drawings themselves. And again, it details what the materials are, it shows what the installation will look like. And the other thing that's very important is any exceptions. For example, when you prepare a specification and a contractor is bidding on the job, there should be a section in the specification where the contractor confirms that what they're providing is in conformance strictly with the specifications that are prepared, and if they're not, a description of and any deviations from what the specifications are, so that you know that they're not going to be doing exactly what the specifications say, and you can evaluate that, which I'll talk about again in a few minutes. So it should give a section to detail any exceptions. Next is pricing and terms. And keep in mind that the price of a project has to be tied directly to the terms of payment, how it's going to be paid, what period of time, and these type of things. But when we're dealing with associations, we're primarily dealing with, we're dealing with existing buildings. And in many, many cases, such as a roofing job or paving job, you can't see what's underneath it and what the additional costs are going to be until you actually start the project. So typically these projects are based on a lump sum basis. Using the roof as an example, the shingle roof, the lump sum would include the cost of taking off the existing shingles and putting the new shingles on, and would also include unit pricing for correcting any damage that you find when you take the shingles off, so that the unit pricing is locked in before the job starts rather than after when you find the problems. So lump sum and unit pricing is the type of pricing that's used on just about every project when you're dealing with existing buildings. Then there's retainage, which I know this will be talked about again in the, by other presenters, but retainage is money that's held back from the contractor during the course of the job so that any punch list work will be completed before the final money is paid to the contractor. The other thing I have to mention is payment terms. Payment terms, some contractors like to get paid a certain amount of money up front, and we generally push back against this and only pay contractors for work that's been completed, so they're not getting ahead of you in terms of the payment. And again, this is something that will be talked about in greater detail as part of the presentation. The specifications also include the schedule for the project, and generally what we'll do is we will ask the contractor to provide us what their schedule is so that we're going by what they feel the job can be done in what time period, so that we can hold them to a schedule because they're giving us the schedule. And in some cases, there may be damages associated with that schedule where if the contractor takes longer than the schedule that they give you, they may be responsible for providing paying the cost of any oversight of that project. But a schedule is very important. Warranties on the work that's being done, as well as the legal terms, which Ronald will talk about in a few minutes. But I just want to mention that the warranties are very, very important. And when you're talking about a roofing job, sometimes the warranties are more important than the roofing itself, because the warranty will tell you who's going to fix what if it leaks. And it's sometimes, when you're dealing with roofing especially, it's very, very important to understand what the warranty is, how long it's for, and what it covers. And that's a key part to the specifications as well as the contract. Next step is bidding. How do you select which contractors to bid the job? Clearly, it should be based on experience, references, and that's the way it's generally done. But in some cases, we're asked to go out for open bidding. And one example of that might be the Dodge reports, where you can actually list a project that's out for bid in a public forum, and contractors, even if you don't know them, can then bid on the project. It's very important when you're doing open bidding to do a very comprehensive review of the contractor's past experience and the quality of their work by checking references, maybe even going out to see work they've done. But open bidding is something that it's not often used in the community association marketplace, but it's something that can be used. Some of the danger zones are that, and that we're actually working on a project right now where the board president recommended the roofing contractor to use. It was a friend of theirs, and in that case, doing the contract administration, we had to shut down the job during the first building because of all the problems we ran into. So a danger zone is using people that are referred to just because of the board may have a relationship with them or the manager may have a relationship with them. So that's just one of the danger zones. The other thing is don't always select a contractor based on low price. Make sure that you meet with the contractor and talk to them to get a comfort level with the work that they do. Also part of the bidding process is a pre-bid meeting where you may go to the community and show the contractors what the work's going to be done and ask them to allow them to ask any questions. Value engineering. Contractors know how to build things, and there's some way at times that a contractor may recommend an alternative way to do a job that's equivalent, which can save money, so you should always be willing to listen to the contractors. How many subcontractors are included in the job? Always want to know about subcontractors because you want to make sure the subcontractors provide insurance and you get proof of payment as the overall contractor is getting paid. Also, the specifications should include bid sheets so that when the pricing comes back, you can compare the pricing on an apples-to-apples basis. Again, I'll mention meeting with the contractor to understand what they're like and how they will operate a job, and then possibly negotiating the job. Next, we move on to contract administration when actually the job is taking place. And oversight is to review the general conformance to the design during the course of the job. I will say that the contractor has overall responsibility for completing the job as specified, and in most instances, there's an engineer or an architect or construction person out overseeing the job at the eyes and ears of the association to make sure the work's being done in general conformance to the design. Keep in mind, this is not meant to be supervision. It's the contractor that supervises their own staff. It's not the engineer that does it. Your expectations of the person who's overseeing the job should relate to the frequency of inspections. For example, if it's full-time, there's an expectation that the person who's overseeing the job is making sure it's done in pretty much in conformance with the specifications. But as soon as you get away from that and you just have inspections when the invoices are submitted or critical phases or before work is covered up, like when the shingles go back in, there's much less responsibility that can be put on the person who's doing the oversight. Who should do the inspection? A lot of people think it should be the engineer, but it really has to be somebody who specializes in construction. And in a lot of cases, just because it's a licensed engineer, that doesn't mean they know how it should be installed. The manager's role. One of the things that managers need to realize and recognize is that sometimes associations feel that they should be overseeing a job and it's not their expertise. A manager has to be willing to say that this is outside of my expertise and we should have someone who's familiar with construction overseeing the job, and the manager would be more involved in scheduling homeowners' calls and payments. The next is punch list. Again, I relate that back to the retainage. If you're holding back money to the contractor, there's a punch list that's developed during the course of the job, and the retainage is released when the punch list work is done. And the last thing I'll mention is to keep in mind that when the job is done, your reserve study should be updated to reflect the new work, and now the work and the cost of the work is being amortized over the full useful life rather than a reduced useful life because it's a brand new component that's been installed. So that's my presentation. I'm now going to pass it on to our next presenter, and any questions you have, please hold them to the end, and I'll be happy to answer them.
Thank you very much, Mitch. In terms of the question, Feel free to start typing them in now, though. This way, if they're on your mind, type them in, and we'll answer them at the end. So I think you have a little chat box, so type them in there, and we'll collect the questions, and then we'll review them at the end. We do have one quick polling question that we'd like to go through, so hopefully everyone sees where they're going to be able to answer the polling. How many of you are planning to undertake a capital project in the near future? If you can answer that, just so we get a feel for where our audience is in terms of planning a capital project, or if they've just recently completed one, and if they're thinking near future, or if this is something that just they're listening to for future reference. So people can just respond to that. Okay, all right, everybody's answered. We're going to close the polls on that. And about 73% of you answered yes, that you're going to be doing a capital project in the very near future. So hopefully you're going to find all of this useful and informative. And again, if you have any questions or want a little bit more detail on any of the items that our panelists are speaking on, please type in the questions in your chat box, and we'll answer them at the end. Okay, thank you. So our next speaker is Ron Perl. And Ron is an attorney and partner in charge of the Community Association Group at Hill Wallack. He is also chair of CAI's Federal Legislative Action Committee and an adjunct professor at Seton Hall Law School. He is a past national president of CAI and has been representing community associations for more than 30 years. Okay, thank you very much, Ron.
Thank you. Good afternoon, everyone. I'm going to discuss three topics: the legal aspects of financing, including limitations on the association's ability to assess or borrow; unit owner buy-in, meaning practical tips for building consensus for the project; the roles of management and professional consultants during the actual execution of the project; and warranty issues. How do you deal with issues after completion? The role of your governing documents cannot be overstated in the context of financing a project. If your association has sufficient cash on hand that can be used for the project, then of course financing is not an issue. However, few associations are fortunate enough to enjoy that status and therefore need to resort to assessments or borrowing. Determining the authority of an association board to assess and or borrow is the first step from the legal perspective. At this point, I want to distinguish between the authority to assess and the authority to spend. I have seen limitations on both in the governing documents, and they look very much alike. Therefore, they can cause confusion. The legal document that would normally contain a restriction on assessing or spending would be the bylaws. The bylaws typically contain a section on powers and duties of the board and would also typically contain limitations on that authority. I use the word typically because there are always exceptions to the general rule. There may be limitations in the declaration, master deed, or certificate of incorporation as well, so it is prudent to check all of the association's governing documents in this process. The attorney should be involved in this process not only because attorneys are experienced in interpreting governing documents, but because the Nonprofit Corporation Act immunizes board members who act in good faith upon the written advice of counsel. So back to the issue of assessing versus spending. What does the typical restriction say? Something like this: capital improvement assessment. In addition to the other assessments herein authorized, the board may levy in any assessment year a capital improvement assessment for the purpose of acquiring or constructing a new capital improvement, provided that the acquisition or construction of any new capital improvement, the cost of which exceeds $75,000, shall be authorized by the approval of a majority of owners entitled to cast votes. This provision illustrates a number of significant points. First, it is entitled Capital Improvement Assessment. The provision is specific to the acquisition or construction of any new capital improvement. I would argue that the term new is redundant because a capital improvement means the construction of something that does not already exist. This is in contrast to the replacement or major repair of an existing common element component. This particular limitation in this document provision does not apply to the expense of replacing a roof, for example, because roof replacement is not a capital improvement in the context of association finance. It may be a capital expense or capital expenditure, but it is not a capital improvement. There are other provisions in the governing documents imposing a duty on the board to maintain, repair, and replace the common elements. When worded like this example, however, the provision addresses the acquisition or construction of something new. Simple examples would include a clubhouse addition or the construction of a new playground. I use this example because it is essential to understand and apply the specific language of each declaration or bylaw provision. The second point illustrated here is that while at first blush it appears that the limitation is on assessing for an improvement in excess of $75,000, the restriction actually limits expenditures in excess of $75,000. Note the language after the word provided, which is in the middle of the quoted provision. Therefore, in this particular association, and I stress this association and every document is different, even if there were unrestricted funds of $100,000 that could be used for a capital improvement without the need for an assessment, owner approval would be necessary because of that language after the word provided. Also, if the assessment were only $50,000, but the cost of the project exceeded $75,000, approval would be necessary. And that is because this limits expenditures, not just assessing. A third point illustrated by this provision is that the limitation number isn't really $75,000. The CPI adjustment would bring the total up to approximately $84,500. The previous example was a provision authorizing a capital improvement assessment. But there are other types of assessments that may become relevant to a capital project. Your association's documents may authorize a special assessment or some other variety of assessment that may fit. Time doesn't permit us to analyze specific language for each type of assessment, but the key here is to review the language of your documents carefully to see if the situation fits and to see if there are conditions to the use of assessment authority. Some individuals assume that a special assessment is available whenever the association needs additional funds for any purpose, but that may not be the case. The takeaways from this discussion are that an analysis of funding and assessment options needs to take place during the project planning stage, and that it should involve the association's attorney in determining the legal authority for the various options. For many associations, borrowing is an important part of the financing equation. We have seen associations obtain bank financing for many capital projects. There is a significant market today for these loans, not like 20 years ago where it was difficult to obtain one because, at least for condos, the lenders didn't understand the concept of income stream collateral. And I think Mohammed will deal with that in more specifics. As in the case of assessments, review the governing documents to determine whether you have the authority to borrow. Often, there's a specific provision, but other times it may be necessary to look at the general provisions regarding the functions of the association and the authority of the board. However, since in the state of New Jersey at least, most associations are nonprofit corporations, you should know that the Nonprofit Corporation Act specifically says that nonprofits have the ability to borrow and create a security interest in its income, which is the income stream collateral. Borrowing from reserves. We're always asked whether an association can borrow from reserve funds. There is no legal prohibition or requirement in New Jersey regarding the borrowing from reserves. There are jurisdictions that have dealt with this legislatively, notably California, but New Jersey has not. New Jersey does require that the operating budget for the association include adequate reserves for repair and replacement of the common elements and facilities. That's a regulation in the New Jersey Administrative Code. Therefore, the borrowing of reserve funds should be done carefully with an eye on future needs and how repayment is to be accomplished. There also may be tax consequences of utilizing these restricted funds if not handled properly, but I'll leave that to the accountants. My advice would be to consult with management, your accountant, and reserve professional if you want to borrow reserves. The borrowing needs to be integrated into the replacement schedule for the community to ensure that funds are available when needed for replacement projects. In other words, the amount of the loan and repayment schedule should be coordinated with the association's overall replacement schedule so that the fund is replenished when you need it. Remember, whenever a capital project is contemplated, new useful lives begin for the affected components. Next, loan documentation. I mentioned earlier that bank loans are based on income stream collateral. In other words, you pledge or give to the bank the right to step in and collect the assessments in the event there is a default on the loan. Most lenders also require the establishment of a depository account of some amount, not only to establish an account relationship, but quite frankly to allow the bank to seize the account in the event of a default. It provides them with additional protection. An attorney should be involved in reviewing the loan documents for a couple of reasons. One, to determine that all provisions are legally appropriate for your association, and to explain the terms to the board. The loan documents contain the terms of the loan, obviously, including the amount borrowed, payback period, and other conditions that should be checked against the commitment or term sheet that you agreed to. They also contain provisions such as waiver of jury trial, acceleration, or other legal matters that the board needs to understand and the attorney needs to review and explain to them. There are provisions on remedies in the event of a default and a description of the collateral. It is obvious that these provisions all have a significant impact for now and into the future and should be reviewed by an attorney familiar with commercial loans. One of the most important functions of the attorney is to write an opinion of counsel, which assures the lender that the association has the authority to borrow, that the borrowing has been properly authorized by the board, and there's nothing in the governing documents that would prevent the lender from realizing the collateral in the event of a default. Attorneys need to be careful about reviewing the form opinion letters provided by the banks because there are provisions that are not always applicable to the situation and may not be true. One of the documents that scares board members, and rightfully so, is what's called the borrower's affidavit, in which an officer of the association has to make numerous representations to the bank that needs to be checked to make sure it's accurate. It is not just a form that needs to be signed. Selling the project is an important part, maybe the most important part of the function of the board and management. And so I recommend the team approach. Each member of the team identified on the slide is an essential part of the team, and missing one would leave a substantial gap in my view. One mistake that associations make is not getting the team together at an early stage to go through the entire scenario. You may not think you need the attorney or accountant at the beginning of a project, but sitting with the entire team does two things. It allows you to coordinate the efforts of all the team members in their roles and understand where they fit in, and it also creates the environment that will facilitate communication with the owners and the buy-in. I can't stress enough the importance of involving the owners early. When the project is fully and completely presented to the owners, they can appreciate the issues and alternatives that you, the board, have been considering. And there's a greater likelihood of acceptance and consensus. This means bringing the entire team to meetings and having them answer the hard questions directly. Have the manager explain about why the project has been considered. Sometimes it relates to owner complaints about leaks or other things. When the inevitable questions are raised, like, can't we do this in a less expensive way? Well, let the professionals answer them face to face. The initial meeting is just the first step. I recommend that the owners be informed along the way as milestones in planning and execution occur. Accurate information is a powerful ally, and you should use it to inform the owners throughout the project. To loosely quote the late Cy Sims, an educated consumer is the best association member. Design and construction. Just a couple of minutes on this. Mitch discussed the design phase. Let's not forget that management, the board, the attorney, and others need to be involved in design decisions. Sometimes there's only one design alternative, but other times there are choices to be made. Some associations have chosen to replace wood siding, for example, with hardy plank or some similar alternative, and you need the attorney's input on whether it's legally permissible to do that. The contract for the designer, the most important thing, is accurately defining the scope of work, and involving the attorney early on helps the attorney understand the scope of work so that it can be accurately expressed in the contract. How about the concept of supervision, which Mitch made it clear that the designers provide general oversight but not supervision. Is the project sufficiently complex with multiple contractors to warrant supervision? Some projects may justify the hiring of an owner's representative to oversee the work. This would have to be done by separate contract with the appropriate individual or firm. And like Mitch, I will tell you that it is not something that managing agents are generally competent to do. In capital or construction projects, the skill set is simply different and requires construction expertise. There are two elements that I want to mention specifically: insurance and indemnification. Designers in their contract need to have an insurance and indemnification provision, and they are frequently the subject of much discussion. Obviously, there is the desire on the part of the design professional and the contractor to shed as much potential liability as possible. And so it is important that the association's interests are protected. This slide contains the important issues that are to be considered in a construction contract. The scope of work, as is set out in the design documents, has to be correctly expressed in the contract documents. Changing the scope after the bid negates the bidding process, so that if a contractor wants material changes from the scope that was in the bid package, you may have selected the wrong contractor. Resist changing the scope when you get to the contract stage. Insurance and indemnification are, again, very important in the construction contract. Assessing the risk appropriately is a key element to negotiating these contracts. Warranties are also important. You'll be getting, will you be getting a manufacturer's warranty? And if so, is this contractor qualified to obtain one? And what is the proper process of obtaining it? It's nice to say in the contract that there will be a warranty, but you have to know how to trigger the warranty and how to make sure that the manufacturer will back it. Construction liens are an issue, so you have to make sure that when you pay the contractor that you get sign-offs from all of the subs prior to disbursement. Each sub is entitled to a construction lien, and you want to protect yourself against those. Another concern relates to materials ordered in advance, both as to custody and payment. The key term, and Mitch mentioned it, you always want to owe the contractor money as opposed to allowing the contractor to get ahead to you. This is also why you have retainage in an amount that is withheld from each of the payments pending final acceptance of the project. The final issue I will touch on is bonding. Performance bonds cost money, but if a contractor fails to complete the job and leaves town, you will at least have recourse. A performance bond is not a warranty, just a completion guarantee. In other words, if it was completed but it, in a short time thereafter shows a deficiency, that would generally be a warranty issue, not a performance bond issue. Remember, bond or no bond, you want to avoid paying the contractor in advance for the work. You want to pay after performance and not let the contractor hold your money for future performance.
Thanks so much, Ron, for all that information. Our next speaker is going to be our own Mohammed. But first, we have a question, another polling question. And that is, this kind of will lead into Mohammed's discussion. How many of you have enough in the reserve fund to cover the project cost? So if everyone wants to answer that polling question. Okay, everyone's pretty much gotten their answers in. Well, this is interesting, so we'll have to address this. About, a third of you think, yes, you have enough money. A third of you think you don't have enough money, and a third of you don't have any idea. So Mohammed will certainly have to address that as, how do you know if you have enough money or not? Okay. So Mohammed, he's a manager here at Wilkin and Guttenplan. He joined the firm in 2001. He specializes in providing audit, review, and compilation services to not-for-profit organizations, closely held businesses, and community associations. He also often performs consulting services and agreed-upon procedures, including fraud detection, forecasting, and transition reports for sponsors and management companies. Mohammed has written several articles and has spoken on various topics relating to community associations. Okay, Mohammed.
Thanks, Carol. All right, so before I get started, talking about the polling question that we got the answer for, it looks like it's evenly spread. The question here is that for those of you who think that you do have, or who believe that you do have enough money in the replacement fund, is it for that particular project that you are doing, or is it in replacement fund in general? Because if it's in the replacement fund in general, as Ron had said earlier, you are borrowing from the replacement fund then, because you're borrowing from the other line items. The ones who don't have it, I believe this session will be really good for you. This might help you in figuring out how to move forward. And the ones who do not know, I suggest looking at your reserve schedule and the line item that you are supposed to have the project for, and checking to see if you do have enough money for that line item, and consulting with your engineer to find out if there is enough money in there to be able to do that project or not. So it all starts with looking at your reserve study and going forward from that. So I'm going to be talking about 4 main areas. Now that you know what your specifications are, and you know you have the buy-in from the unit owners, how are we going to fund the project? If we are obtaining a loan, how to go about doing that, what are the requirements, recording the project itself, and then working or dealing with the cash flow throughout the project, and if you do have a special assessment. So how do we fund the project? We talked about the replacement fund. In a perfect world, if you have enough money in the replacement fund for that particular line item, you have the project, you do it, you pay for it from the replacement fund, and you move on. Unfortunately, that's not always the case. And if needed, in a lot of cases, you may have to have a special assessment. So one thing you need to consider is what's the length of the special assessment. Some associations have the ability to go to their owners, unit owners, and have them pay the special assessment as a one-time assessment or over a short period of time. If you can do that, you're in a much better position. But unfortunately, the way things are, the way the economy is now, that's not usually the case. So if you are doing a special assessment, you may have to spread it over the term of a loan if you are getting a loan. So the loan that's funded by a special assessment or an increase in maintenance fees, if you have an increase in the maintenance fees, some associations decide to keep that increase going even after the project is done, so that you fund the replacement fund at a higher amount, so that in the future you do not have to deal with a situation like this. Now, if you are deciding to go for a loan, what type of loan do you want to get? There are mainly 3 types of loans. One is a line of credit, where you get a line from the bank, which is usually 18 to 24 months. The rate for the line of credit may be tied to prime or LIBOR, or in some cases with larger banks, they may actually have a floating rate. So overall, the rate could be a little lower. The benefit of this is that, of course, it's a shorter time. You pay back the loan as and when you get money from your unit owners. Again, the disadvantage of this also could be that it's a shorter time and you have to collect the money over a shorter period from your unit owners. The second type is a term loan, which is usually for capital projects and that need to be funded over a longer period. You can have a term loan for 15 years, but normally 10 years is the typical term loan. It can be fixed for the term of the loan, but some of them usually have a reset after 5 or 10-year intervals. Rates are usually tied to the corresponding treasury rates. For example, if you have a 5-year loan, then it would be tied to the 5-year treasury rate. Rates usually have a floor that they cannot go below. So for example, if you have a loan that's tied to the 5-year treasury rate, and then it has possibly a basis of 150 to 250 basis points. So if the 5-year treasury rate is 1.41 and you have 200 basis points, then it goes up to 3.41. But if there's a floor of 4%, then it doesn't matter. You will not go below the 4% floor. Very often we find associations doing a hybrid of the two types of loans. So you have the term loan later on. You start off with the line of credit during the time of the project itself, and then you move over to the term loan for the balance that needs to be paid off once the project is done. Considering the current interest rate environment, I mean, we can just say it's competitive. So shop around before you make a decision. Now, what kind of requirements are there from the banks when obtaining the loan? First of all, they're looking at the number of owner-occupied units within the association. If you have at least 80 to 90% owner-occupied units, you're in a pretty good position. Associations that have high rentals tend to find it harder to get loans because the banks usually shy away from rental units. Also, in a rare case where you have an association that is still under developer control and that's looking for a loan, you may have a hard time getting a loan because, again, banks do shy away from associations that are being held by the developer or under developer control. The banks also look at your delinquencies and your foreclosures. They're not as concerned with the dollar amount usually. They're more concerned with the number of units that are delinquent. So if you have 15% or more of the units delinquent, you may have a harder time getting a bank to give you money. They also look at your financial statements, your audited financial statements. If you have no deficits in the operating fund, then you're in a much better position. Associations that have 2 or more years in a series that have deficits, again, do find it harder to get a loan from the bank because deficits to them means that the board might not be doing their fiduciary responsibility of collecting enough money to pay for expenses that are being incurred. Banks also look at associations that are funding the reserves because it shows, again, that the board is being fiscally responsible. Before you decide to go to the bank, you need to make sure that you already have the project set up, you have a good idea of the total cost, and all your approvals from the township or everywhere else are already in place so that the bank knows that you are all set to go, and you're not just fishing around for any kind of loans before you know what you're going to be dealing with. It's always better to have a relationship with the bank before you start talking to them about a loan, especially if you have an account with the bank, it puts you in a much better position while working with them on getting the loan. Now, collateral for the loan. Not all banks will deal with associations in getting loans because the type of collateral that they have, that associations have, is very different. There are no fixed assets on the books. So what banks look at is getting assignment of future income, your special assessments, your maintenance fees. They have a blanket lien on all associations' assets that are on the books. A lot of board members ask us, do I need to give a personal guarantee? There are no liens on units or from board members. No guarantees are required because they are putting a blanket lien on all your future and current assets. Now that you've decided that you're going to get a loan, where do you record the project and how do you fund for it? You can decide to use your replacement fund for the loan, but that could possibly put the replacement fund in a negative balance, and it may be a little difficult to record it, and it may be a little difficult to understand during the process of the loan itself. We definitely recommend that you use a separate fund whereby you will record all the expenses that you're incurring throughout the process of the project itself, and you record all the special assessment funds that you're collecting from your unit owners. The third option is to use the operating fund. However, using the operating fund tends to get messy and is prone to having erroneous groupings and allocations, and you may not be able to track the total cost and the funds for the project and the special assessment. Now, if you are recording or if you are instituting a special assessment, it will be recorded in the beginning in full. So once the special assessment has been approved and you're moving forward with the project and the loan, you record the whole special assessment as income to that separate fund, and you record it as a receivable on the books. When you're recording the special assessment or when you're instituting the special assessment, you need to keep in mind delinquencies. If people are not paying their maintenance fees, they're not going to pay the special assessment. So when you're calculating the special assessment, record or keep in mind the delinquencies and make sure that you're recording the special assessment or you're putting in a special assessment that's inclusive of people who will not be paying. When you're recording the special assessment, you also, during the course of getting the loan, there will be certain other costs that will be incurred. There are origination fees that you will have during the time of getting the loan. You need to record that. Also, there will be some legal fees that you will incur during the course of getting the loan. Those will be amortized over the loan period that you're paying off, because these are costs that are incurred for the loan, and they need to be expensed over the period of the loan. While the project is going down, you will draw down on the loan, usually if you have a line of credit, and if people are paying you during the time of the project itself, you may reduce the line of credit that you have. Make sure that when you're paying the project during the course of the project that you record the retainer portion, because that will help you manage the cash flow, and make sure that you have the money at the end once the project is complete and all your costs are complete, and you've made sure that you're all done with the cost of the project itself. Making sure that you're accounting for the cost is extremely important during the course of the loan. Cash flow and paying down the loan. Timing of the assessment and allowing lump sum payments instead of installments. Some banks may allow you to reset the loan during the course of the loan itself. If you have unit owners who are selling their units during the course of the special assessment, you may collect it at the time of the sale, and then we recommend that you pay off the loans as soon as you get the money from those unit owners. And if the bank allows you to reset it, please make sure that you do it, because that will allow you to pay a smaller amount during the remaining course of the loan itself. There may be certain cases where during the course of the special assessment you have delinquent owners who were paying before but may not be paying. So it's possible that you might not collect enough money to pay off the loan. You need to keep that in mind and make sure that you're budgeting correctly in case you do have such delinquents. Now, once the loan is done and you're done with your project, you will have a separate fund. In a perfect world, you would have a fund that closes itself, but it may not always be the case. In case you have a balance in there, if you have a surplus, if you've been paying off the loan faster than what due to unit owners paying off their balances when they're selling, you may have a surplus. We recommend through the budget process, you transfer that to the replacement fund. However, if you have a deficit, it's possible that you may have to budget for it through the operating fund and transfer it to the operating fund to pay off that deficit. All right, I think we're done with my section.
Thank you so much. So we have a little bit of time for questions. I'm just going to, while we go through the questions, I'm going to leave this screen up there so you can see it, so you have everybody's contact information. If you want to email anybody directly, feel free to do so, or call, and also everybody's website is there in addition. So we'll go through some of the questions that have come in. We'll try to get to them with the remaining time. So this is probably for Mitch and maybe Ron. Who will provide inspection of work if not the engineer? So we thought you're hiring an engineer to do that. So if they're not going to do it, who should do it, and what would be their qualifications?
Hi, this is Mitch, and I'll turn it over to Ron. When I made that comment before, what I was talking about, for example, is I have an engineering firm where I have a number of licensed engineers and a licensed architect. But the people who do the inspections in my office may be those people, but there are also people in my office that are not licensed engineers or architects that specialize in construction. So my overall opinion is that it should be somebody who specializes in construction, but who does not necessarily have to be a licensed engineer. So that's what I meant by the comment before.
Ron, you have anything to add on that?
Yes, I made a comment about an owner's rep, and of course it depends on the complexity of the job, but in a rather large job which is complex and has many working pieces, you may want to have very frequent observations made by the person who makes sure that the construction is being done properly. And so the engineering firm certainly is the first line of defense, and again, you can use personnel within the engineering firm, and the question is simply the frequency of the observation. There are engineering firms that don't want to do it or don't have the manpower to do it on a more frequent basis, then you get somebody with construction background and training to do it. I think each of us agree that management company personnel are generally, and of course this is the general statement to which there are always exceptions, but they are generally not trained in construction and therefore can't serve that function.
What do you think about having a board member serve that function?
That is the worst idea that I've heard in a long time.
This is Mitch. Well, keep in mind, and I'll be an attorney for a second, if a board member starts overseeing this kind of work, then they're accepting the responsibility on behalf of the association that it's done right, and it's not a third party representing the association.
Right. You really want somebody who's going to take responsibility and be liable in the event that the job is not done correctly.
Okay, thank you. Another question that I think, Ron, you mentioned in your presentation about involving owners and selling the project to owners. So there's a lot of information that goes to obtaining financing, and Mohammed, you mentioned about delinquencies. How much should be shared with the homeowners in terms of delinquency rate and financing rate, and how much should be shared and what's confidential?
Well, I don't necessarily suggest sharing the delinquency lists. That's really not necessary to inform about the nature of the project, the necessity for the project, why it's being done, why it has to be done now, why it's being done in a certain way rather than alternatives that may be less expensive. But I advocate giving the owners as much information as is humanly possible, because when reasonable people are given the same information, they'll generally come to the same conclusion. And I'm not suggesting that certain associations don't have unreasonable owners, but the more information that is shared with the owners, the more likely it is that they will understand, accept, and agree with the board's decision.
Mitch, you have something to add on that?
Yeah, my comment doesn't have to do with the finances of the project, but it has to do with the aesthetics of the community. And I would suggest that any time an association is doing an improvement project, such as a roofing or siding or something, that aesthetically relates to the association, that it should be shared with the owners, especially if you're changing the colors of anything or the look of the community, because the safest thing to do is change it and make it look exactly the same. But there's no question that in many instances, by changing the look and the color, that you can add to the value of the community. But it's very important to share that with the homeowners.
Yeah, can I add one more thing? Information should not only be shared with the homeowners may actually have valuable input that could assist the board and its professionals in making the right choices.
Yeah, we've done, for example, renderings of a building that sits in the clubhouse so people can look at what the buildings are going to look like after a job is done, so they can see how much nicer it would look than it is the way it currently stands.
Mohammed, do you have anything to add to that too?
Yeah, if an association has delinquent owners and you have a receivable on the books, then the owners already know that there are some owners, some union owners that are not paying. I think it's, while calculating the special assessment, they need to be aware that we're taking this into account. It's better to know beforehand what you really are going to be paying, rather than after the project you go back to the owners and say, oh, because a certain number of you did not pay, now the rest of you have to pay for it. You don't have to give the actual names, of course, which you can't, but at least they are aware that there are delinquent owners, and the ones who do pay are paying for the project.
So you're not saying not to assess the delinquent owners. Should
No,
the delinquent owners
absolutely
be
not.
assessed also?
Absolutely not. You assess everybody else, but you're being realistic and putting in a buffer or a cushion in there for those people who don't pay for it.
Okay.
This is Mitch again. Just make a comment. I don't know if it was mentioned before, but for example, let's say you're doing something that the reserve study said it will cost $100,000 to do, and you have $5 million in your account. If the job costs more than $100,000, you can use some other money from your reserve fund. It doesn't have to be limited to that individual line item component amount that's listed in your reserve study.
So you know, Mitch, you bring up a good point. A lot of people say, well, let me borrow from another line item, but then what's the risk there? There has to be some kind, if you're spending more than what you've allocated that line item, there has to be some other issues with that.
Well, you have to keep in mind that the line items are, I mean, there's different types of funding, and it's a whole other seminar talking about threshold funding, full funding, or baseline funding. But in a reserve study, at least in the state of New Jersey, there's no reason why you can't use more that's in that individual line item if you have a total fund, which is a significant amount of money that sits there for a long period of time. And Mohammed wants to say something also.
Well, it all depends on when's your next big project. Supposing you're doing the roads now and you need money and you're going to borrow from the reserve, but in 2 years you're planning to do the roofs. Now you need to make sure that you have enough money to do those roofs, and you may borrow that money, but you're absolutely right. You can, but you need to have proper planning to make sure that you have the money for the next big project that's coming up.
That's why the cash flow analysis in a reserve fund is very important to look at when you're planning these type of projects.
But it also means that after you use the funds that you borrowed from another line item, you have to redo the reserve schedule so that you are collecting enough money over time that when you next need it, it will be there.
Absolutely.
Yes, definitely.
Okay. All right, that's great. So we talked about, just real quickly, you know, we talked about retainage and having retainage, and what about if a contractor doesn't allow retainage? Does that have to be in a contract?
It should be in the bid documents, in my opinion, that that is the documents on which they submit their bid. And if it says that there's going to be a 10% retainage, for example, and they bid anyway, it's really their problem. There are other bidders who are bidding. That's why I made the comment, trying to change the deal after the bid is accepted is problematic. And I would certainly recommend, and I heard Mitch say this as well, that you have to be into the contractor for money and not the other way around. And retainage is one way of doing that. So if after receiving the bid, the contractor now says, oh, but I'm not going to agree to retainage, then they didn't really submit an acceptable proposal.
And I would say the retainage is critical in these jobs. The two things are critical is making sure the contractor doesn't get ahead of you in terms of money, because then something happens to them, you're on the hook for the money and they've got it. And retainage to make sure that the punch list work is completed. Very, very common in these type of projects.
Okay. We have time for one last question, and that is, you know, we use the words or the terminology contract administration and construction management.
Go ahead, Mitch.
Real quick.
The difference in my mind is that construction management means that you're dealing with multiple different subcontractors, and the construction manager is coordinating between subcontractors rather than contract administration, where you probably have one general contractor and you're overseeing them totally, and the general contractor is responsible for the multiple subcontractors. Ron may have a different definition, but here you go.
No, it's very close. Contract administration is general oversight of the project, in my view, as opposed to construction management, which is actually doing the bricks and mortar stuff and supervising all of the subs.
But I'll also make a comment, which I think Ron said before, is that if you have a construction manager handling the job, you still may need somebody to oversee them because they're acting in the role of a general contractor.
Agreed.
All right. Well, our time is up. We want to thank everybody for listening to our webinar. We hope you found it informative. Please fill out the survey that you're going to be receiving. We welcome your feedback. If you need to reach any of our panelists, their email address, their phone number, their websites are all listed here. Thank you very much, and have a good day.